Hi everyone, welcome to my channel The Business Finance. I have come up with this new channel to share as much knowledge I have related to the financial world. So the topic that I have chosen today is market capitalization, and the things that I would be covering under market cap is that what exactly it is, why do we need market cap, how it is calculated, and what are the different types of market cap. And then there are many terminologies that you might be hearing about, like free float market cap, diluted, and implied. So we'll go through one by one and we'll explore what is it all about. Okay, so first of all, what is market cap? So market cap, it refers to how much a company is worth. So that means if you want to derive like what is the equity value of any organization or any company, then market capitalization is a very helpful metric for you to calculate like what exactly is the worth of that organization. So whenever any company goes through its IPO process, they have their share price and then they have their share outstanding, and then at that point of time its market cap value is also derived. So any investors who wants to invest into any organization or they want to invest into any company, they would like to compare it in the like how this company is versus this company. So for this comparison, the investors prefer to use market cap. How we are calculating market cap would totally depend upon the share price and the outstanding shares. So as you can see, the basic market capitalization is derived by multiplying the share price into the number of outstanding shares for that company. Here is an example, like for any ABC company, if the share price currently is at $10 and currently the outstanding units is like 100 units, so the market cap value would be 1000. Now, important thing here to understand is that what is share price and what is outstanding shares. If you are clear about these two things, then it's very easy for you to understand that how is basic market cap value is derived. So share price is actually the value of one share in any company. Like I mentioned before, whenever any company goes through its IPO process, so at first the value of that company is derived by its share price, and then the share price keeps on increasing and decreasing depending upon how this company is doing or what would be the external factors. So here is a screenshot that I have attached for IBM, and it says that for today the share price value is 145.55 USD, and this is something it will keep on fluctuating throughout the day. I'm sure you guys may have heard of about last sale price and close price, and these two values with these two values we are able to derive that how is this company performing. Then moving next to share outstanding. So whenever any company is declaring its stock or they want to go through this IPO process, so at that point of time they decide at how many shares they want to keep it for public, which would be into trading, and then few shares would be like they would be restricted to the company people, the trust, and you can say all the company's officers and insiders. So all of them would keep some certain amount of shares with them. So basically at whenever this company is declaring that how much shares we would have, so this overall this common stock that we say, it's called as the share outstanding. Now this value is not at all static, it keeps on fluctuating over time. That means every organization quarterly they will declare that this is the value of their shares. Like in March it was this value, and then in June it was this value, so it keeps on fluctuating. Some companies, instead of using share outstanding, they prefer to use weighted average of outstanding shares. The reason of using is this because their outstanding shares, they are like they are subject to too much of variation over time. So in this scenario they use this weighted average of outstanding shares. Like for example, I have attached here a screenshot. If you will see, the company has declared here weighted average common share outstanding for different time frame. They have declared like in February 2020 it was 1887,502, the basic one, and then in January 30 2021 it was 84,258. So you can understand that it keeps on fluctuating. This is one more example that I have attached. This is for Yahoo Finance. So in case you want to understand like all, you want to find what is the share price, what is the share outstanding, what is the market cap. So just go to the home page and type in the company name here. Like I have given here IBM. So it has told me like this is the market cap, this is the share outstanding, and if you will go up, you will be able to find what would be the value of their share price. Okay, so types of market cap. I have covered three types of market cap here. Usually there are five, which is mega and micro as well. But here I've covered large cap, mid cap, and small cap. So when we focus about large cap, that means the amount of the market cap here is beyond $10 billion. So when we talk about Apple, IBM, Microsoft, so these companies fall into large cap. Then mid cap organization would be like $2 billion and $10 billion. So these companies are such companies which would, I would say, these are medium sized enterprises which may with time would perform very good, and they may fall into large cap categorization. And then is a small cap where the market cap of them is $10 million to $2 billion. Now, there are a lot of speculations with respect to the return and risk. Some say, and it's mostly the same, that for large cap, these companies are very stable. So, the risk related to them is very low, and also the return, which sometimes is low. But again, this cannot be guaranteed. Similarly, if you go for the small cap companies, you will hear it a lot of times that the risk is quite high and the return can also be quite high, but it's not necessary that would be the case. You may also lose all your money. So there's a high amount of risk in this. Okay, free float market cap. So I think we are very much aware about basic market cap now. The very popular topic, or you can say right these days now we are discussing about, is free float market cap. So what exactly is it about? Now, free float market cap, it came into the picture because we are trying to cover here the share outstandings which are actually available for public to trade. In basic market cap, like when we are deriving the value, we are considering the shares which are held by public, and then shares which are restricted also. The privately owned ones. But in free float market cap method, we are making sure that we are relying only the outstanding shares which is held by the public. So if you will see the formula, it says the share price into the number of shared issues minus locked in shares. So we would not be considering the shares which are locked by the company insiders, or you can say which is not being traded by the public. The most popular example is S&P 500 index, which has started considering this free float methodology. They would be considering those companies into their index with which would be falling into the large cap with this free float methodology. The other ones which are also popular is MSCI World Index, and the other is the FTSE, the Financial Times Stock Exchange Index. Now, what are the advantages of using free float market cap? First of all, it will give you a very practical picture. You would be able to understand that in reality how many shares are available for them and how much it is presently locked in. It gives you a very clear picture about the organization. Then no distortion of the valuation. That means market cap of large cap companies, they can fool investors into thinking that its shares are readily available for trading when the reality is quite different. So when you decide you want to invest into this company, you believe it's good, but you would not find the shares available for trading. So this gives a very clear picture. Then market driven methodology. So this process eliminates companies that only have minimal amount of shares available for trading in the market. So it will tell you again the reality, like it will tell you that it will like, for example, if we consider this S&P 500, it will eliminate the companies that have too much of large cap being concentrated because of the locked in shares. So this is one benefit of free float market cap. Okay, now the other big terminology is diluted market cap. I'm sure you must have heard that the market cap of this company is impacted because their shares have got diluted and all. So this is something very popular that sometimes we hear it in news. So what happens is that some companies, they have the categories of like options, warrants and bonds with them. For example, if I say that I have joined ABC organization, and at the time of joining they told me that you will get 50 options with the tenure of 5 years. So once you have completed 5 years in this organization, you would be able to exercise those options. That means that those options would be converted into shares, and once those shares are converted into you can say shares, then the number of share outstanding in the market, it has changed. So if you will see here, let me minimize the screen. Okay. So if you will see here, the diluted share calculation, now these are the different categories. So now if I have diluted these shares, like after dilution I have exercised them, and these are like 35, 27.5, so total 102.5. These are the new shares that have come up in the market. Now if we go by the basic calculation, it's like the share price into share outstanding. But when it comes to diluted, now you can see that earlier it was 1000, but now this 102 value which we were able to see here, it has been added here, 1102. Now because the share outstanding value has increased, it will indirectly decrease the value of the share price. So basically this market cap, if you will divide with these share outstanding, definitely the share price would be decreased. So why this diluted market cap is important is because you can say that it's a way for the investors to understand that if the company exercises all of its options, what is the reality of the shares, what is the reality of the market cap. So that's why investors prefer this. And for calculating this diluted market cap, we use treasury stock method. Maybe I can prepare some other video on this for to understand about this TSM method, but we'll skip it for now. Again, this is one example where you can see that this is a annual statement of any company, where they have shown here that they have exercised their stock options. Now in they have exercised their 144 common stock here. This gives you an idea like how they have exercised these options and how the share outstanding have been impacted. Now moving to the last type of market cap is implied market cap. uh, if any company, like if for example any company exists, I would be a general partner and I decide some other person to be the limited partner. So depending upon their investment into my company, I will give them some amount of shares. So I can be the general partner and there can be two or more limited partners who would be like, as much as they are investing, the same amount, the same amount of shares I will give to them. So in basic market cap, we were considering like share price into share outstanding. But here the share outstanding would have additional shares. And what are these additional shares? These are the limited partner shares. So for example, if some ABC person was holding 200 shares with him, now those would be diluted and the share outstanding value would be increased, and that is how we are trying to calculate the implied market cap. Now the factors that impact market cap, number one is the significant changes in the price of a stock. So like for example, if we consider the scenario of this COVID situation, now all the companies have been significantly impacted. There are so many companies who are not able to function the way they are supposed to. So this has definitely impacted their share price value, and eventually they have affected the market cap. Second is when a company issues or repurchases shares, like the diluted market cap example. If they have decided to dilute their options, warrants, and they have decided to do like repurchase more shares, so in such situations there is a high tendency that the market cap would be changed. So I would be closing this video on a note that yeah, market cap is something which investors use to understand that what exactly is the worth of the company, and they are trying to derive the equity value. But you would never get to know the exact worth of the company until and unless you are not considering all the debt it holds. Maybe, for example, the equity value is high, but even the debt can also be very high. So in such scenario, you should be going for enterprise value. It would be considering your debt, equity, all the all the liabilities that you have. Keeping in mind all of this will give you the exact picture of the company. So many investors, they consider market cap, enterprise value, and all these factors are considered whenever they are thinking of any organization. Thank you.